Guess who's back in town? China. They are investing $2 billion into mortgage-backed security debts in the United States. This is great news for the mortgage industry and real estate community because they were one of the largest investors prior to the meltdown. That is where a lot of the money was coming from that was funding a lot of these exotic type loans. And not that those loans are coming back by any means, but it is a good thing that confidence is being built in the U.S. mortgage and real estate industry. People around the world are seeing that our real estate economy is poised for a rebound. So they're getting in, they're investing money now so that they can make some returns on what they feel is going to be an increasing market over the next 18 months to 36 months. So that's great news for our real estate industry where people from the outside looking in can see some positive things happening, and money is starting to flow in from other countries now that are going to start supporting what we're trying to accomplish here in our real estate market. Part 2 of Who Done It? Who caused this mortgage meltdown? Yesterday I talked about the upper echelon, the people in the White Tower who started kind of creating this this meltdown. It was the investor, the overseas investor. Then you've got the fund manager. Then you've got the ratings company who rated those collateralized debt obligations so high with those ratings to entice the investor, to give them what they wanted, but also to get paid, because if they didn't rate it high, if AM Best didn't rate it the top grade rating, then Moody's would get the business and they would rate it at a top grade. So it was incentive. You know, you've heard the term follow the money. That's what you do in this case. Follow the money. It goes all the way to the top. So what I want to talk about today was the wholesale lender, the mortgage broker, and the consumer, and how we each are responsible, and then the checkpoint along the way that we should have, understood and stopped this from happening. So the wholesale lender basically had to produce products that the investors would purchase from them that were going to go into these collateralized debt obligations. Now, in order to create a product that looked good on a balance sheet, it had to be structured in such a way that it made the bank look good at every point. So those products were pay option arms. That was one of the major ones that were used, where a borrower would pay a 1% payment, but their fully indexed rate was 8%. Their balance was going up all the time as they were making payments on their loan, and the asset, the home, was being devalued because the loan balance was increasing. So even though these loans were rated at a AAA grade, they were actually probably just, they're dirt, they're garbage. And so what happens was that on a bank's balance sheet, that loan looks great. I mean, it looks like they're making an 8% return on a mortgage loan. The guy has got great credit and, who's making a payment every month, because it looks like they're making that much money on the balance sheet, because there's a practice called general accounting practices, and the banks were taking advantage of this by skewing the balance sheet. Because of these rules that are in there, they could show that they were making a profit at that rate of 8%. Now, those products were being pushed upon the consumer by the broker, because the broker was being compensated 3 and 4 times as much as we were on a 30-year fixed loan or a 15-year fixed. So the money that was being made at the wholesale level, the investors level, was being trickled down to the broker to keep that in front of the consumer so that those loans were originated and funded. If they continued to get funded, the bank could continue to get money from the investor, and it was just a system that fed upon itself. And the mortgage broker should have been, scratch his head and said, look, man, why are we getting paid so much money on these? If you look at the mathematics of this loan, it does not make sense. It's not good for your average borrower who's a first-time home buyer or even a move-up buyer, because they're putting 20% down or maybe 10% down, and within the first couple of years, their down payment's eaten up. And what if property values go down? They're stuck in this loan. So the mortgage broker should have scratched his head and said, man, this might not be good for the consumer. Then the final part of this whole equation is the consumer. And if the consumer didn't understand what they were signing and what they were looking at, ultimately they are responsible. And they should know exactly what they're getting into as far as a loan is concerned. Now, that might upset some people for me saying that, but really the buck stops there if they weren't comfortable and they shouldn't have done anything. So, there is a level of accountability at every place, and everybody is responsible. But, there are circumstances at the consumer level where the mortgage broker took advantage of that borrower. So I understand that happened, and borrowers aren't required. They shouldn't have to know the ins and outs of every loan program. That's the broker's job. That's the lender's job to be able to explain that to them. But ultimately, we are all responsible at every level. So hopefully that gives you a general overview of what happened. Now, there's a lot of other mitigating circumstances that come along the way, but this is a general idea, a really boiled down, easy version of what happened. And this won't ever happen again. The risk was too great. The default rates were too great, so we'll never see these kind of loan products again. If we do, they will be in such small numbers that they actually won't even be on the map. So just get steaming forward with that 30-year fixed loan, because that's all you're going to see for a while. Make sure you check out the links in doc section below, and make sure you keep clicking on that HVCC petition. Some great news came out about that yesterday. The Wall Street Journal had written an article just hammering the AMCs for the treatment of the appraisers, and how they were sending them off to great distances to do appraisals in neighborhoods that they don't have any information about. They don't know about the current market conditions there. They're paying them $175 for an appraisal, and expecting these appraisals to get back in a really short amount of time. The Wall Street Journal basically said that it was a bad thing, and it's great that HVCC is getting bad press. So the goal here for this petition is to get 150,000 signatures nationwide. And once that happens, the two gentlemen in Southern California, the two mortgage brokers who actually put this petition together, are going to take it and present it to Fannie Mae, Freddie Mac, and Andrew Cuomo, and they are going to show how devastating that this has been to the real estate industry. Also, coupled with that, the House Bill HR 3044 that is on the table now, that's got 54 co-sponsors. It started out with 2. Now it's up to 54. That is, in conjunction with this petition, is going to cause this bill to pass, I hope. So keep clicking, keep having your colleagues and friends sign that petition, forward out to everybody that you know, so that we can get this thing removed and start changing the way that the conforming appraisal process is done. Also, make sure that you look at the poll question. I want to know about the HERA laws. If anybody has seen any delays from the new disclosure period that's required on all mortgage loans now. So check that poll question out and make sure you click there. Also, make sure, again, check out that referral section and refer quality people to your clients and to your colleagues. Also, don't forget that first-time homebuyer credit tax form and the list of HUD required repairs. Also, that 203K marketing plan that I talked about the last 2 days. Having a huge response on that, so send me an email. I'll send you that PowerPoint presentation, and we'll get that stuff in your hands so you can start marketing that 203K loan on those tough-to-sell listings. So again, thanks for clicking and watching, and if you got questions, email me. I'll get back to you as quickly as I possibly can, and we'll see you tomorrow.
I'm leaving on a jet plane. I don't